Hi, Suzy Rhoades here with PassMasters. Welcome to Math Made Easy. In this video, I will discuss expected return, the capital asset pricing model, and alpha. Understanding these concepts and knowing the math related to them will help you with your Series 65, Series 66, Series 6, and Series 7 securities exams. Let's look at the definition for expected return. The expected return on an investment is the expected value of the probability distribution of possible returns it can provide to investors. Expected return is calculated by multiplying potential outcomes, returns, by the chances of each outcome occurring, and then calculating the sum of those results. So it is sometimes a math question. So that will be your formula. The expected return is based on historical data, which may or may not provide reliable forecasting of future returns. Hence, the outcome is not guaranteed. It's just what your investor can expect to earn. No guarantee. Expected return is simply a measure of probabilities intended to show the likelihood that a given investment will generate a positive return and what the likely return will be. The purpose of calculating the expected return on an investment is to provide an investor with an idea of probable profit versus risk. This gives the investor a basis for comparison with the risk-free rate of return. The interest rate on 3-month U.S. Treasury bills is often used to represent the risk-free rate of return. Let's practice this type of a question for a single security. Investment P has a 20% probability of giving a 15% return on investment, a 50% probability of generating a 10% return, and a 30% probability of resulting in a 5% loss. What would be the expected return on investment P? So we have some choices here, 8, 15, 6.5, and 11. So now is the time I want you to pull out your handy dandy non-programmable calculator. It helps to practice with one of these instead of your phone, since at the test you will be given something very similar to this, or there will be a calculator within the computer program. So either way. So what are we going to do here? We're going to use our scratch paper and we're going to multiply. So the 20% probability times the 15% return. 50% probability times the 10% return, and 30% probability times the -5 return. And then you take those numbers and you add them all up to get the expected return. So let's do that together. So we have 20% times 15%, and we can make these into their decimals. You multiply that out and you get 0.03 plus 50% likely to earn a 10% return. So we're going to take 0.5 times 0.1, and that's going to give us 0.05. Always double check it with your calculator. 0.5 times 0.1, 0.05. Got it. Plus, so we're going to add these numbers up. 30% likely to generate a 5% loss. So 30 times -0.05, 0.3 times -0.05 equals -0.015. So we're going to add all of these together. 0.03 plus 0.05 minus 0.015, which is 1.5%. And we get 0.065, which is in a percentage, 6.5%. That is what the client can expect to return given these probabilities of these expected returns. The probable long-term average expected return for investment P is 6.5%. This is an example of calculating a discrete probability distribution for potential returns. Where did this information come from? The probabilities of each potential return outcome are derived from studying historical data on previous returns of the investment asset being evaluated. The probability stated in this question might be derived from studying the performance of the asset over the previous 10 years. In other words, assume that it generated a 15% return on investment during 2 of those 10 years. So that's why we took the 15% times 20%, a 10% return for 5 of the 10 years. That's why we took the 10% times 50% and suffered a 5% loss for 3 of the 10 years. So we took the -5 times 30%. So you multiply those out, add them together, and that gives you the expected return. Now, that's not the only way I expect you to see this term, expected return, on your test. So that is one way it may appear, where you have a historical data and you multiply them out and add them together. That's one way. Another way is in relationship to the capital asset pricing model. The capital asset pricing model is a market equilibrium model developed by Professor Sharp, Trainer, and Lintner, 1964 and 1965. The capital asset pricing model built on some key ideas that were developed by Professor Markowitz and his modern portfolio theory in 1959. The capital asset pricing model is an equilibrium model in that supply equals demand. The capital asset pricing model describes the relationship between the expected return and risk of investing in a security. The capital asset pricing model is grounded on the theory that investors demand higher returns for higher risks. I think that's true, right? If your investor is going to invest in something that is riskier than something else, they demand a higher return. The capital asset pricing model shows that the expected return on a security is equal to the risk-free return, such as the return on a short-term treasury security, plus a risk premium, which is based on the beta of that security. So these are things that are going to go into the formula for expected return using the capital asset pricing model. The capital asset pricing model formula is used to determine the expected return for an individual security, not a portfolio. The graphical representation of the capital asset pricing model formula is a line called the security market line. So what is the capital asset pricing model formula? The expected return on a security is equal to the risk-free rate plus the beta of the security times the expected return on the market minus the risk-free rate. So we'll practice a question here. The risk premium is the expected return of the market minus the risk-free rate. Remember, you can always choose that safe investment, the rate of return on a 3-month treasury bill, a 91-day T-bill, or you can choose something riskier. So what is the risk premium? The expected return of the market minus the risk-free rate. The capital asset pricing model formula is used for calculating the expected return of an asset. It is based on the idea of systematic risk, otherwise known as non-diversifiable risk, that investors need to be compensated for in the form of a risk premium. So it's important to remember, because there's going to be quite a few formulas and they get kind of jumbled in your mind. On the test, capital asset pricing model, when we're doing this individual securities expected return, we're going to look at the beta of the security. So the beta of the security measures how volatile is it as compared to the market as a whole, as compared to the S&P 500. So that is the adjustment for systematic risk, for non-diversifiable risk. A risk premium is a rate of return greater than the risk-free rate. When investing, investors desire a higher risk premium when taking on more risky investments. That is true. That is what normal investors will demand. We know that. Let's practice a question related to expected return with the capital asset pricing model. The following information about a stock is known. It trades on the NYSE and its operations are based in the United States. Current yield on a US 91-day Treasury is 2.5%, so that's going to be our risk-free return. The expected return for US stocks is 10%. The beta of the stock is 1.25. What is the expected return of this security using the capital asset pricing model formula? Another way they might say it is using an equilibrium model, which means you need to know to apply the capital asset pricing model formula. So let's look at what are our givens in this question. Risk-free 2.5, expected return of the market 10. So you're going to use your scratch paper to keep track of all of these numbers. And the beta of the security that you're considering or that you're trying to determine the expected return for is 1.25. So it moves more than the market as a whole. So the formula for the capital asset pricing model, we're going to take risk-free 2.5 and we're going to add it to the beta 1.25 times the expected return of the market 10 minus the risk-free return 2.5. So we're going to have 1.25 times 10 minus 2.5, 7.5. Don't forget to use your handy dandy calculator for this kind of math. 1.25 times 7.5, you get 9.375. So we're going to add to that the risk-free return, 2.5. The expected return is 11.875. So let's look at what our choices are. 11.9, so they just rounded it to the nearest tenth. You have to know how to do that. So what did we use in this equation to adjust for the risk? We use the beta of the security. The test loves that concept. The test is going to try to trick you when you are determining an individual security's expected return using the capital asset pricing model. Do you adjust for risk using standard deviation or beta? You use beta. So when you're doing the security market line calculation under the capital asset pricing model, use beta. If you were determining the expected return for a portfolio as a whole, then you would use standard deviation. So standard deviation is used as the measurement for risk in both the capital market line equation and the efficient frontier. But when we're doing the security market line under the capital asset pricing model, expected return for an individual security, we use beta. So I would write that on your scratch paper. There's going to be so many things to try to remember for your test. This is one that's easily just mixed up. I don't want you to miss it. The last topic for this video is the concept of alpha. In the capital asset pricing model, as I reminded you a few times, it is beta that measures the volatility of potential returns. So when we're looking at what is a security's expected return, we used beta. Beta is derived from calculating the asset's sensitivity to a market's movements. Beta is a measurement of the security's non-diversifiable risk, systematic risk. So now that we know what beta is, what's alpha? Alpha is often the stated goal of active portfolio managers. Active managers seek to generate alpha in diversified portfolios. Alpha is compared to the expected return given from the capital asset pricing model. If an investment beats out the expected return from the model, it has achieved alpha. So it's this idea of, should you invest in an index fund or an actively managed fund? If the portfolio manager doesn't beat a benchmark index, then what's the point, right? So any active manager worth their grain of salt is going to create alpha. How might this concept appear on a securities exam? Security W has an actual return of 30% and a beta of 1.1. The risk-free rate is 8%. The expected return of the market is 20%. Which of the following is true? So we need to figure out what would an equilibrium model have predicted for this investment, because it told us what its actual return was, and it gave us the information we need to determine what its expected return is. Our givens, risk-free 8, that's really high, but you just go with what is given. Beta is 1.1, and the expected return of the market is 20%. Expected return of the market, 20%. So the formula for the security market line under the capital asset pricing model is going to be risk-free return plus the beta times the expected return of the market minus the risk-free return. So we're going to have 1.1 times 12% plus 8%. So whichever way, some people like to write them as percentages and some people like to write them as decimals, and I tend to put them together in a question, which could be confusing to you, so I don't want to confuse you. So whichever way you like. So handy dandy calculator, 1.1 beta times 12%, 13.2 plus 8. So this is giving us what again? This is giving us the expected return of this security. Now, what did it actually earn? We need to know what it actually earned because that's how we determine if alpha was created. So if the expected return is 21.2 using the equilibrium model and the actual return was more than, then we have created alpha. So alpha is just the difference between these two numbers. So alpha for this security is 8.8%. So our choices on this question: Roman numeral 1, security W earned less than predicted by an equilibrium model. Well, that is false. It earned more than was predicted. 2, security W's alpha is negative 8.8. False. So it's not 1 and it's not 2. 3, security W earned more than predicted by an equilibrium model. That is true. And security W's alpha is 8.8. So the correct answer is Roman numerals 3 and 4. And you can definitely expect this type of question on your securities exam, where they have 4 answers, 4 choices. It's like making one question into 4. Very mean of the people that write these exams. It is true that you can have negative alpha. Positive alpha is desirable. Negative alpha is not, of course. There's one more thing I want to point out related to this concept of alpha and expected return. Sometimes the test ties into when alpha is created, that the security that you purchased was undervalued, that it was not priced correctly, and it was a good buy. So when alpha is created, a security was undervalued. Those concepts are sometimes tied together on the test. That's it for this Math Made Easy video. Those are not easy concepts. The test loves expected return. using probability, and then expected return using the capital asset pricing model in the security market line. And then how does that tie together with alpha? Now you know. Thank you so much for watching. Please give this video a thumbs up, subscribe to our channel, and turn those notifications on. If you would like to check out PassMasters course offerings or to enroll in any of our courses, there is a link found in this video's description. If you have any questions at all related to this video, ask me in the comments below. Keep up the good work. Happy studies. You got this.